If you, despite attempts, cannot come off the charts and are in a constant need of doing something, if you cannot patiently hang on for the result of your trade and interruptedly tweaking your charts and changing assumptions, then you are most likely a servant of the market. The more time you spending and compulsory observing the results, the more attention you devote on the process and the more parameters you obsessed to forecast, leading to a so-called process of analysis paralysis, the bigger chance you will lose. Today, about how to not get lost in these volatile markets, this volatile realm, and and maybe moreover what to focus on the most when approaching the market on the upcoming week. So welcome to the new episode of Blockrevision in a market update series. Let's get straight to first section. Okay, and we are in an economy view. What we have in the subjects lying ahead. Let's have a look at the great pivot everybody is waiting for. Does it may come sooner than later? The question is. So recently on Friday, as we will go have through this in an market mover section, we were going through the wage decrease recently. So the wages have increased by a lower amount than the forecast, and that's what surprised the market. Alongside, we had labor market data that was also surprisingly well, or at least not much worse than expected. So every time when it's, I would say, kind of positivity in economic data, it usually sparks those elements of speculation around the fact that when the market is going better, they would may hike interest rate even more. And with this time where we have a wage decrease, or possibly the lower wage increase than the forecasts, it would mean for the market that it prompts the Fed to hike interest rates by even lower notch. So as we can find right here, wage inflation is rolling over across the income distribution. Slowdown in wage inflation is exactly what the Fed is trying to achieve with the tighter monetary policy. Note how it's happening without an increase in the unemployment rate. Low inflation with a steady economy and steady earnings is the definition of a soft landing. That's the one of the voices of an pundits that had its discussion on Bloomberg. So yes, so especially with the possible steady earnings, that's what I'd like to emphasize. And I would like to ponder about this one. So we have earnings this week. The only one reason for soft landing is that we have steady earnings. But as we do find economy is slowing down, it's an undoubtedly known fact. This interest rate hike policy has led to an imminent market problems, and right now many of the companies has problems with maintaining its pricing power. So as we would expect on Friday, when this earnings season is commenced, we will find out whether those earnings projections will eventually look not that bad as many of the bears is looking for this. But as we do know, there will be very difficult to achieve. Maybe those lowering earnings are already priced in and discounted by recent price action when we had a slump on the US 100 recent week and 2 weeks ago by around 10 to 15%. But it's still very difficult to say before those publications being put in the limelight. So yeah, that's about a possible pivot that right now I would seem unlikely, but more and more market participants are expecting just 25 or maybe, yeah, I will show you out the expectations of the market. And for this one, I will get you to our CME Fed watch tool, and as you can find right here, we have target rate probabilities for 1st February 2023 Fed meeting, and 77.7% of market participant is expecting this one to increase by just that low amount. So so we are right now, let's maybe have a look at what is current interest rate chart of Fed. So right here we have federal funds effective rate and as we can find, maybe I will just narrow this down. We have 4.10 and it's expected to get us to 450, 475 and not higher. So that's why tomorrow's meeting with a Fed chair Jerome Powell will be key in order to assess what the environment says about the possible that low interest rate hike. All right, we are jumping back to our slides, and that's the central banks are deliberately causing recession. That's what BlackRock said. So central banks are tied with investment firms and hedge funds that are deliberately sometimes causing a recession when they have much of a bigger size of put options than the calls. They are pushing the market down, even not physically, not directly, but indirectly with this manipulation processes. So have you ever noticed that when the stock market starts to normalize and head upward, such institutions as Goldman Sachs immediately publishes a doom and gloom story to deliberately accommodate their cronies to who have placed puts in the options market? And so there is a heated debate that those power brokers should be restricted from publishing open source free opinions that have clearly been placed in the media in order to instill some of the moods, whether it's fear or optimism, and steer the market in any of direction. Let me know in the comment section below or in the chat that's going live. What do you think about that? I'm very glad to know your opinion. So also just let me know whether the transmission is running fine. Thus, this sound quality is somewhat good. So BlackRock said that recession is foretold as central banks race to try to tame inflation, um, um, and everything will be fine about that if not BlackRock. So that's a report from a company that's, as some people claim, that's destroying neighborhoods and lives by buying thousands of homes and turning them into overpriced and poorly managed rental units. They are raising rents and evicting tenants without a care of for the condition of the properties. BlackRock only cares about the bull market because they are so leveraged in real estate assets after the last real estate crash. So after something something happen, they will be impacted more than anyone else. The crazy rents they are charging and the asset values on their balance sheets will be way off, causing them to have a harder time or will be more expensive for them to get loans. So I would say that we should elect people to investigate and really figure out the shadow money and the massive amounts of corruption going on with this manipulation. And that's the type of stuff we should have government doing, breaking up these massive schemes. There is free money out there, meaning we are all actually deserve more than we're getting, but there is people out there making so much more than they deserve, and they get away with it having complete support of the working class who is focused on conspiracy theories and anti-liberalism. So I would say that BlackRock right now is in the second side of the fence when they have fed against BlackRock. This battle is very, I would say, maybe audacious in its results, and they will be very difficult to predict the outcome. So as in the 2021, BlackRock has stand for Fed's side right now. It's in a opposed one, and I would say that one of them will get bust. Maybe not a good bust, but I will have a tough time. And BlackRock is definitely the market participant that may suffer the most current market environment during this environment. Okay, that's a very interesting chart right now. VUG to VTV. So it's a growth stock ratio regarding value stocks, and we are right now get back to the levels of early 2020. So right back then there was a COVID crash, and the ratio started to reverse when we started seeing such a rally of growth stocks, since a ratio of 1.47 up to around 30ish. So right now, as we have erased all of these gains, we may see right now a look for a turn, slow turn, but evident turn into more growth stocks than during previous year. But for this, we would need to observe any type of market bottom or bottoming process, if you may say so. Within such of a bottoming process, I would observe any type of building an engulfing pattern, or the rectangle box that may eventually end up with a strong breakout to the upside, and any other pivotal formation that which plays which play alongside a nice volume. Uh, Without this, we would still see an increasing tendency as it's right now here at the right lower corner, where appetite for value stocks has increased, and it's to increase in the first quarter by markets participants, uh, according to Bloomberg MLIV Pulse service. Um, so right now I'm just noticing that value growth stocks is in a very getting to the more and more fine place to take position at right now. After erasing all of the growths, we may start eventually taking the entrance on this market, and this will be very indeed very difficult at first, as those before any type of head upward may happen, we may see a jolts on the way, and there might be shaky way that may lead eventually to that reaction. So we need take time of bottoming out that may take place. But let me know in the comments or the chat, what do you think? I would like to know your opinion, whether it's the right time to take a growth position right now with such relatively low valuations. But we are heading to the next slide right now. Shaky quarter ahead. I don't know, but risk manager says that there will be the quarter of easing inflation, and retail investors saying that it will be rather a quarter of cost cutting. So we don't know right now that retail investors are literally the market participants that take their investments or trading opinions based on what happened in the past. So this recency bias is the common phenomenon that is hitting retail investors, and I would say leading them to such of a calamities in terms of investment results. So better get rid of any type of overestimating the past regarding of what may come in the future. I do know that extrapolating of what may come next based on what happened in the past is very often used, I would say, tool in a economic projections kind of scheme of projection, but we don't know that any type of mindless projecting what may come next and projecting the prognosis based on what happened in the past without any type of peculiar analysis is literally leading to problems. So retail investors are betting that cost cutting will be the one of the main problems, or rather the biggest positive driver of S&P 500 earnings. But risk managers are expecting that that will be an easing inflation. So right now, we would rather see that what the risk manager says, that have an higher and better insight in what's happening upon data analysis. So without easing inflation, there won't be a growth, I would say. Even if we would maybe observe the cost cutting that will be the big driver, I would expect that it's overestimated by retailers. So the easy inflation absolutely is the one thing that may be a catalyst for growth and also lowering this interest rate hike, but I wouldn't overestimate them as well. So I would strictly observe easy inflation as well with improvement in supply chains, but with this China opening, that's kind of a question mark issue, but I would observe both of them, and if any of them will surprise us to the downside, I would be becoming more and more cautious. What's next? Next is market outlook, and for the market outlook, we would like to have a look at. Let me find out. We would like to jump to an DXY. So what is our most important, I would say, one of the most important alongside bonds market determinant of risk of factor. So DXY right now is heading to the area of that I have pointed previously. We may even assign it with this extended line. On DXY, yes, we've formed somewhat of the bottoming formation, but for this we need something stronger, such as engulfing pattern that hasn't been built right here. It was just a rebound out of this floor at 103, 103, 30, 41. But we do need something that may confirm the pivot from the area of 102, and I do expect that will happen after grabbing the liquidity out of this support and heading towards 102.82, and that will happen very soon. So I do expect that most indexes will suffer during this time, and it will be the second half of January and February as well, as normally taking such of a analysis of seasonality, that's not very favorable time for the market to thrive. So that's about the DXY. Right now we are getting back to market outlook, and once again discussing DXY, taking regard on what the positioning is. So hedge funds are growing ever more bearish on the dollar, underscoring speculation the Federal Reserve will slow the pace of its interest rate hikes. But normally when hedge funds are increasing their position in a one side or the other, it usually means that more and more market participants have seen already the current trend, and it's getting more likely to revert. So I would stay very cautious on the hedge funds standpoint, but as always, we do know that hedge funds are not the market participants that have an enormous results, and I wouldn't really bet or rather follow the hedge funds guidance as it's successful rather not than Yes. All right. That was about the dollar peak. Right now, market mover section, and as always, we are heading to economic calendar. What we have up out there this week. So on Monday, 9th of January, um, we had unemployment rate from euro area, and it's as expected. Economic optimism, IBD, TIPP. So it's worth watching in order to get broader spectrum of an issue. In terms of Wednesday, oh sorry, I've omitted this one. Obviously, that's Fed Chair Powell's speech. So that's what market is watching very carefully every single time. Right after we have inflation rate of China, as it's still at astronomical levels of 1.6%. It's unbelievable, but it's a different economy, as we do know, not so dependent on this Russian energetic resources. In terms of Thursday, we have core inflation rate and inflation rate out of the US, so it's very important indeed. And on Friday, GDP out of Great Britain and out of Germany, alongside ending with consumer sentiment out of US. So that was it. So we have a very interesting week ahead with a CPI reports, as always, as the leading indicator, alongside that driving the market up or down. If the inflation rate will be lower than expected, we would see possible rise on the market, as it means that Fed may lower the interest rate hike even further. What about earnings calendar as it's approaching? The most important, I would say, is to look at Thursday's data, as it's chip maker Taiwan Semiconductor is having its day of earnings, and that will cast a shadow on the whole sector and alongside the US 100, of course. On 13th of January, we have banks, JP Morgan, Bank of America, Wells Fargo, BlackRock, Citigroup, so on and so forth. So it's the banking sector that's most often are kicking off the earnings calendar. So we'll have projections on the next quarters. Maybe those recent slumps have been discounted already by those possible lower results, but we'll find out yet. And it's not about what will be the results in January, but rather what will be the outlook for the next quarters to come by those